Welcome to the MUFG Global Markets Podcast. I'm your host, Ellen Tang, and today I am joined again by Glenn Schultz, who is the head of our agency mortgage prepayment modeling and strategy for MUFG. And today is Wednesday, June 14th. Glenn, it's nice to have you with us again.
Hi, Ellen. My pleasure. And thank you for having me.
Of course. So, as we always like to start off with these podcasts, we can talk a little bit about last month's remit data that was released on Tuesday, June 6th. So kind of if we go through what the report showed us, as measured by the Fannie Mae 30-year prepayment, it reported that 6.2 CPR was up about 22% on a month-over-month basis, well underperforming the business day count convention, up 5% month-over-month. The 15-year sector reported a 7 CPR, which is up about 17% on a month-over-month basis. And then lastly, the Ginnie Mae sector, 30 and 15-year prepayment reported around 7.5 and a little over 10 CPR, respectively, also outperforming the day count convention. So after kind of, running through that data point, I have two questions for you. The first one would be, over the last 2 months, remit data has supported your turnover forecast, which is much higher than that of the market. So how confident are you that your turnover forecast will be realized? And then the second question would be, May's month-over-month performance, outperformed the street consensus. So how did the Katana model that you have created perform with respect to its prediction? And to somewhat put you on the spot here, do you plan to publish the model's forecast?
Yeah. Okay. With regard to the first, I'm pretty confident really, that the spring summer turnover prepayment will likely come within our range between, kind of the 8-10 CPR, kind of turnover number there. Albeit it's going to be at the lower end of our forecast. I don't really follow street consensus much, but from what I've read in kind of the financial press, it seems that kind of most other dealers or prepayment analysts have raised their turnover forecast based on what they've seen in the last couple of months. And that consensus seems to be closer to around kind of the 6%, 8 CPR range. So there is some convergence on the turnover point now between where our forecast is and where the street was. So they were kind of more like 4.6, and now they're 6.8. So that's where I think, their high end and my low end are kind of coming together. Then with respect to the second, our prepayment model, which we named it Katana, predicted a month-over-month gain of 25%. So, when you put it in context, our model overshot the mark, but it sort of outperformed street consensus, which is, based on their models. So those models had basically followed day count. And so, it overshot, but I was pretty pleased with where it was, because the first time I saw that, I was kind of like, wow, that's a big divergence between, kind of where our model is and where the street was. Now, in terms of prepayments, I generally don't like put the model's prediction in client notes, kind of for two reasons. The first reason is we don't put it in the client notes because really the focus of most of my work is making sure that Katana is running flawless on a day-to-day basis, because we use that for our risk, and then that enters into our financial reporting. So that's the main thing for me. And then we're on our third major iteration of the model, which is I'm super pleased with it. And so I think once we get that into production in Q3, we're going to start looking at, what it would take for us to begin publishing that. So we're starting to hang the pieces around the prepayment model that we would need to be able to publish our predictions.
Got it. So last month, you mentioned that you felt the basis was oversold and current levels looked like a good entry point. Could you give us a refresh on what your view is on the basis today?
Yeah, right. Well, to be fair, I had felt that the upper end of the basis would be limited to around 180 basis points. At that time, the basis had reached a high just around 170 basis points. So I thought that was kind of a good entry point, given where, I thought that the upper limit would be. But there was adverse excursion against that forecast, and the basis hit like an intra-month high last month, like at 192 basis points, which had surprised me somewhat, as I kind of really view 180 basis points as kind of like a hard line, beyond which the market is then signaling financial distress. So that kind of concerned me a little bit, that we had even gotten to like 192. But still, the basis rallied, and now it's trading around 163 basis points, which is really right on top of the 26-day exponential moving average. So that really puts us in the middle of kind of the plus minus, 2 standard deviation range, that Bollinger Band range. And I'm still holding to my forecast that the basis will close the year around 120 basis points. So my reasoning for that is kind of based on the following. First, there's an upward revision in terms of turnover. So we've seen that. That's going to favor, in my view, an upward valuation of kind of the 4.5 and lower coupons. And that represents the majority of the coupon stack. So I think that would pull the current coupon basis, in somewhat, right? And then the second is the bank liquidations have gone, far better than I had expected. And in my senses, they've gone far better than the market had expected, right? And now, of course, we're past the budget drama, and it appears there was little harm in terms of any kind of negative ratings or views attached to those negotiations. So I viewed that as very favorable. And then finally, I just feel the supply technical right now favors a tighter mortgage basis going forward. So, given these 3 factors, I feel pretty good about a year-end prediction around 120 basis points, but we still have a ways to go. So we'll see how it plays out to year end.
Finally, where do you see value in the agency mortgage market right now?
Yeah, well, I mean, at this point, I'm a little bit like I feel like a broken record, right? So, I favor the 3 and the 3.5 low and moderate loan balance sectors. The 3 and 3.5 Florida geo sector, that's kind of played out pretty well. And then the 3 and 3.5 FICO sector. So those are where I've been kind of focusing, and that view hasn't changed much since November 22. So that's why I feel a bit like a broken record, but they have performed well, and I just feel like those sectors provide a reasonable trade-off between carry, in the sense that they get a little bit higher than TBA sort of prepayments, and the longer duration of, say, the 2 or 2.5 coupon cohorts. So I kind of think that that's the trade-off that makes the most sense when I look at the market. And so I'm kind of sticking with those sectors for now until something changes on the prepay front, really.
Fantastic. Well, Glenn, thank you very much, as always, for joining us on the podcast. And on that front, we could feel free to rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And please reach out to your MUFG sales rep for any further information. Please check back soon for more insights from the Global Markets Research team.